We just had surprising inflation and unemployment data out of the US, which have changed the shape of markets once again. Hello and welcome back. Markets down across the board again today in reaction to key CPI or inflation and unemployment data out of the US. We're going to break it all down for you in just a second, but first let's jump into the charts and have a look at where we are right now in terms of price. Bitcoin currently sitting at a price of $60,400, having bounced up from support at around $58,855. As you can see, we did indeed break through local support at 59,900, confirming a downtrend since the highs that we put in back on the 27th of September. Now, we knew that there were leveraged long positions that were going to be liquidated if the price was to move below that $59,900 level, and that is exactly what happened. If we look over at CoinGlass, we can see that within the last 12 hours, around $100 million worth of long positions liquidated out of the crypto markets in general. And over the last 24 hours, around $145 million worth. You see that a little more clearly in the heat map. Over the last 12 hours, around $60 million worth of those long liquidations came from Bitcoin specifically. Market is even more scared than it was yesterday. We are now down to a score of 32, down from 39 yesterday. We are very definitely within fear on the fear and greed index. And as we always like to do, looking across at the ETFs, you can see that the 10th was another net outflow day. In fact, it was the largest of the last 3 consecutive net outflow days at $70 million net outflows from the spot Bitcoin ETFs. Now, as we always say, cliche as it is, it generally pays to be bullish when the rest of the market is scared, to be brave when others are fearful, and to be fearful when others are feeling brave. We know right now everyone is definitely not feeling brave. Everyone else is feeling fearful. They are scared. We see that in the fear and greed index. We also see it in the exchange liquidation heat map here on CoinGlass, where you can see there is a much, much greater amount of leveraged short interest in the market than there is leveraged long interest in the market. Now, it's not to say that the leveraged longs are not significant. We saw that last night as we took out some of those longs to the downside. But every time that happens, we see more participants come into the market and get leveraged short. And what that means is there is always an opportunity for the exact opposite of what we saw over the last 12 hours or so playing out to the upside, where if prices move quickly to the upside, those shorts become trapped, they become liquidated, therefore they are forced to buy to cover their short positions, meaning demand shock on the market and prices go up. Higher demand, constant supply, prices go up. So just to contextualize this, from the high of yesterday at $61,200, that would represent around about $500 million worth of short positions that would be liquidated if we were to move up through that level instantly now. And that number climbs to around $1 billion worth of short positions that would be liquidated if we were to move up to a price of $61,500, just a little bit further up the book from here. Now, to further contextualize that, take a look at this chart by Bitcoin Magazine, essentially mapping the price of Bitcoin versus the fear and greed index. Now, the general trend that we can see here is prices tend to go up after periods of intense fear in the market. Once the market gets into greed, then prices come down again. But crucially, look back in 2019, extreme fear just before a big pump. 2020, extreme fear just before a big pump. 2021, extreme fear just before a pump again. And the same thing was replicated, although it played out over a long time horizon between mid-2022 and then early 2023 before we started the last leg up. Right now, you can see we've been in a cluster of fear days. Just something to pay attention to. Once again, and I can't say this enough, it generally pays to be brave when the market is feeling fearful. Now, all that being said, we can't ignore the fundamental catalyst that started this move to the downside over the last 12 hours. And I am, of course, talking about the CPI, i.e. inflation, and the jobless claims data that we had out of the US at 8:30 a.m. Eastern time. So Wall Street ends slightly lower after higher than expected inflation and jobless claims, specifically September CPI data being higher than expected and unemployment claims being much higher than estimates. We'll get into that in just a second. Investors seeing these as indications on the health of the US economy and, most importantly, the path for future interest rates or future interest rate cuts. Why do we like interest rate cuts? Well, generally speaking, when the interest rates are cut, i.e. lower, that means there is less money to be had in yield-bearing investments like the bond market, and that capital tends to flow into risk assets like equities, i.e. stocks and crypto. So to start, let's look at CPI, and you can see that came in at 2.4% versus a forecast 2.3%. So this is technically a miss, even though it is down on last month, which was 2.5%. Now, CPI has been trending down since May, and it's known that the Fed is looking for this to stabilize out at around about 2%. So even though this is a miss on the forecast 2.3%, i.e. it's slightly higher by 0.1%, the general trend there is still down. But if we look over at FedWatch, we can see that since the data came out, the expectation of no rate cut at the upcoming meet in November has popped up to near enough 20%, and there is now an 80% expectation of a 25 basis point rate cut. Any expectation of a 50 basis point rate cut, or of another 50 basis point rate cut, as I should say, is pretty much gone to the wind now. Where is that coming from? Well, if we look at the composition of CPI, we can see that most of the reductions or the deflation that we've seen has basically come from housing, food, and medical care. Now, if we look over at the data for core inflation, that is inflation data that has excluded the highly volatile food and energy categories out of the basket of goods against which inflation is indexed, you can see that this is actually raised over the last 2 months, coming in at 3.3% versus a forecast 3.2%. The forecast was in line with the last 2 months, and that means we have actually seen an uptick in core inflation, and that is likely where the change in sentiment has come from in terms of the expectations for future rate cuts. Now, we've also got to consider the initial jobless claims coming in at a staggering 258,000 versus a forecast 231,000, and last month's reading at 225,000. As we've spoken about before, job market strength is generally an indicator of stock market strength, basically because it means increased consumer spending and it means increased confidence in the economy. Now, it is speculated that at least a portion of that increased unemployment claim is coming from Hurricane Helen distortions. Nonetheless, that comes in stark contrast to the strong jobs data that we saw earlier last week. And the bottom line is it's just not good for equities. It's just not good for risk assets. So to summarize, core inflation data basically bringing into question how much of a rate cut we're going to get at the next cycle, or if we're going to get a rate cut at the next cycle at all. On top of that, we have got jobless claims in excess of expectations, bringing into question the stability of the jobs market right now and putting further downward pressure on equities. That being said, we've already seen a bounce in the S&P 500 since lows put in immediately after the data came out. We are seeing a bounce currently in Bitcoin since the data's come out. We've almost retraced, I'd say about 75% of the move down, currently sitting at a price of $60,400. And on top of that, the market is very scared right now, and there is a lot of short interest, meaning that there is a lot of leverage in the market waiting to be liquidated if prices can push just a little bit higher, and there is a chance of that domino effect happening, where one round of leveraged short positions being stopped out leads to another round of leveraged short positions being stopped out, etc., etc. As always, that is not financial advice, just my opinion, just my take. Thank you so much for listening. Plenty more to come. Catch you in the next one. Cheers.